Hey there, Velocity Bankers. Welcome back to our channel where we turn financial mountains into molehills, where we turn 30-year mortgages into 5 to 10-year stints. This is a Velocity channel. Listen, today we're tackling a big one, all right? And it's how to pay off any loan, okay? It's huge. How to pay off any loan early without making any extra payments. Now, that sounds impossible, doesn't it? Well, buckle up, because we're about to make the impossible possible. Every time you turn on the channel, that's the way it is. Let's go. Before we do that, though, like, share, and subscribe, because a lot of more people need to learn about this. So first things first, let's talk about what a mortgage is. It's a death pledge, all right? That's what it means in Latin. It's like that gym membership you can't cancel, but instead of getting abs, you get a house. And just like that gym membership, there are ways to get more bang for your buck, okay? And so we're going to go through the traditional banking ways of how to pay off any loan, and then we're going to go ahead and go into the velocity banking way of how to pay off that loan. So strategy number one, it's always to what? Refinance, right? We want to refinance. This is like trading in your old beat up car for a shiny new one with better mileage. By refinancing, you can get a lower interest rate, which means more of your payment goes towards the principal and not the interest. However, is there something better than that? And that would be the opportunity cost that we would miss out on if we would just refinance the mortgage, refinance the car, refinance, instead of seeking a better way, all right? So strategy number two is to recast. And if you need to learn more about that, go ahead and look it up, because I'm not going to bore you with it. But by making a large one-time payment, you can lower your monthly payments without extending your loan term. That's actually the gist of it. I know that, we can get into it more, but I'm so raring to go on this better way to pay off that loan very early, okay? So strategy number three is making bi-weekly payments. And we're going to show you what that looks like right now. All right, so making bi-weekly payments, this is like running twice a week instead of once. You're not running more, you're just running more often. So by making payments every 2 weeks, you'll end up making an extra payment each and every year without even noticing. And that's the gist behind it. So instead of, right, making the $1,200 payment outright on that month, you're making $600 every 2 weeks, right? And you'll go ahead and make another $600 every 2 weeks. And, at the end of the year, guess what? You've made an extra payment. Whoop-de-doo, right? Comment below to see some ideas on how that is actually helping anybody, all right? I'd rather go ahead and do this instead. Now, I'll tell you what I'd really rather do. I'd really rather put in what I make, right? Put in what I owe, and then have a system letting me know how to pay off this thing early. Oh, wait, I do. We do have that. Many of us do have it. And if you want it as well, just let me know. And that right here, I believe it's right here. You can click to learn more about that. But let's go ahead and get into how you can make any payment. I mean, you can just eliminate that debt early, like way early. And it goes like this. Do you need a line of credit? Guess what? No, you don't, right? Now, even though that would help, right? You don't need a line of credit to pay off your mortgage, your car loan, any loan, payday loan, any loan early. All you need is a system, and we're going to show that to you right now, all right? So what you're going to do is, let's take the $12K loan, right? When that money comes in, what you're going to do is you're going to take a huge chunk. Anybody know what PacMan looks like? Anybody know what PacMan looks like? Are you guys so young that you don't know what PacMan looks like? Let's go ahead and show you what PacMan looks like. So I wanted to give you an illustration of what I mean by velocity banking. Every time you think of velocity banking, what I want you to remember is PacMan. I want you to remember this picture right here, because this is velocity banking in a nutshell. This joker right here is called PacMan, all right? And you're going to take, let's say, from your line of credit or from your DOA or from your checking account, wherever it comes from, that money, $6,000 is going to chunk, you're going to chunk the principal of the 12K, because this right here is the principal, $12,000. Well, it's something about the principal, okay? Guess what feeds off of the principal? The interest. Okay, there's another little Pac-Man. The interest is feeding off the principal, and that's where all that money that you didn't know that you owed came from. It's adding up. It's getting bigger and bigger because it's feeding off of that principal. The smaller the principal, the smaller the interest. The bigger the principal, the bigger the interest. And so, let's say it's 20%, right? But guess what? Now that we've chunked, right, the $12,000 with $6,000, guess what? The little interest Pac-Man is chunking off of now. Huh? What is it chunking off now? It's chunking off, it's feeding off of 6,000, right? Let's say you have a 3-piece meal. Let's say you have a 6-piece fried chicken meal with red beans and rice. Come on, shout out. Huh? With a big biscuit, with a big buttermilk biscuit right there, okay? And the more you eat that, the less food you have. Is that correct? The less for other parasites to get. And so it is with this principle. It's the principle. It's the chunking principle. The more you take out of the principle, the less the interest is going to bite off. And that is the power of velocity banking. And so every time, let's say you have the income coming in the $5,000 and you have the outgo of $3,000, well, you have that $2,000 there, right? And if you kept that inside of a line of credit, guess what's paying off of the line of credit? Guess what's paying off the line of credit? That cash flow. And so, without making any extra payments at all, right, you find that this $6,000, right, that was going to go somewhere, is now going towards the mortgage. You say, well, CJ, isn't that an extra payment? Well, is it? You actually can subtract years off of your mortgage from paying the principal like that. Now, of course, it'll need to be a bigger number, especially if you're talking about $250,000 mortgages, right? But if you've got the money there and you're wanting to utilize it, can we think of it? Would it be of value to you to think of this money being wisely allocated, right? Being wisely transferred instead of making a payment? Because I know, let's say $18,000, that seems like an extra payment, CJ, doesn't it, right? Does it, right? Well, let's look at it. So listen, folks, I just have to come clean with you. I don't see how it's an extra payment if it doesn't seem like I'm paying extra. Does that make sense? I guess it's all about the timing. And I think that's what they mean by time is money. Because you can make the minimum payment off of a $12,000 card, of a $12,000 loan, right? And end up paying $20,000. Now, to me, that's extra payment. You know what I'm saying? That's extra payment. But chunking, right? Doing the chunking principle and chunking your loan down to where you make a total of $13,000 with $1,000 being the interest, right? For taking that loan. I mean, come on, they did let you borrow the loan for $12,000, huh? Why not give them a little something, okay? And let's just say it's $15,000. Let's just say, watch this. Let's just say it's $18,000, which is astronomical, right? But it's still less than $20,000, right? Paying that minimum monthly payment. And so the chunking principle, what it does is it collapses time, right? Which in turn collapses the interest. And that's what we want to do. We want to cancel as much interest as possible so that we could have the lower amount instead of the higher amount being paid out over time. Because people are paying way more for mortgages in the long run as they continue that minimum monthly payment of $1,200, $2,000, $3,000, and they think their $300,000 house is just $300,000. It's not. It's about $500,000. It's about $600,000. It could have gone in their pocket. But my goodness, we have an answer for you, and it's been flashing across the screen. Okay, and It's called automated velocity banking. We want to tell you more about it. We want to show you more about it. We want you to enter your numbers, right? Not on a whiteboard, but inside of the system, and then allow the system to give you results that will cause you to pay off that mortgage in as little as 5 to 10 years, to pay off that car loan, to pay off the signature loan, to pay off the credit card, to pay them all off, and then to build wealth for yourself. Not 40 years down the road, but maybe 5. Talk to us. God bless you, and you guys have a great night.